Have you ever wondered how hedge funds invest? How they make billions of dollars each year? Well, in this video, I'm going to lift the veil on hedge funds. I'll tell you what they are, how they typically invest, and how you might be able to implement some of those strategies in your own personal investing. My name is Anish. I was a portfolio manager for almost 10 years at two of the most respected hedge funds on the planet. I've traded billions of dollars across multiple assets, from FX to equities and commodities. So what is a hedge fund? Well, they're investment vehicles that are typically located offshore in jurisdictions like the Cayman Islands, the British Virgin Islands, or Jersey. All of these jurisdictions treat hedge funds favorably from a tax perspective. Hedge funds raise capital using investor relations teams, which can be internal or they can be external. They raise capital from allocators like pension funds, sovereign wealth funds, ultra high net worth individuals, and even university endowments. The second thing about hedge funds is that they use leverage. What this means effectively is that they borrow dollars from somewhere. Most often that's from their prime broker. And this allows them to take positions that are larger than the assets that they have under management. And they will invest using this capital across various asset classes. So an asset class could be equities, it could be fixed income, or it could be commodities. And they will use a range of instruments. An instrument could be something like a future or an option. And lastly, on the commercial side, hedge funds charge a management fee and a performance fee. The management fee is typically 2% and it's applied to the entire asset base, whereas the performance fee is about 20% and it's applied only to the trading performance. So if you take the example of a $100 million hedge fund, the management fee will be 2% of 100 million, which is $2 million. The performance fee of 20% is applied to trading performance. So if the hedge fund returns 10%, which is $10 million, 20% of that is $2 million. The reason why hedge fund managers become so wealthy is because of the management fee. Although it's smaller in percentage terms, it's applied to the entire asset base. So what this means is hedge fund managers get paid whether they deliver trading returns or not. So what are their main investment strategies? Well, they can be as varied as there are hedge funds in existence, and there are thousands of hedge funds out there. Broadly speaking though, equity hedge funds take a long-short approach. They run a market-neutral book. So they'll be long a certain number of stocks and they'll be short another group of stocks against that. Macro hedge funds trade trends and inflection points in the global macro economy. And primarily they focus on interest rate derivatives and foreign exchange. There are many other hedge fund strategies out there. Some focus on commodities, some focus on credit, but the bulk of assets under management in the hedge fund industry is run by equity funds and macro funds. Many hedge funds make use of derivatives, including futures and options. Options can be helpful to a portfolio manager because they control downside risk. They can also be helpful because it allows portfolio managers to take very specific and nuanced views into and around events. The one thing that's common across all hedge funds, across all asset types, is their search for alpha. Alpha is a unique and relatively undiscovered source of investment returns. And hedge funds are very secretive about this, and they'll spend millions and millions of dollars trying to identify new sources of alpha and then trying to protect that. But what's interesting is that alpha doesn't have to be a super complicated or complex set of algorithms. It can just be doing the simple things well. And it's those simple things that we're going to talk about next. And most of those you can apply to your personal investing. So how can we approach our personal investing like a hedge fund? Well, every successful portfolio manager has a clear and repeatable investment process. And that investment process is comprised of two parts. Firstly, trade identification, and secondly, portfolio management. On the trade identification side, there are two pieces: fundamental analysis and technical analysis. Fundamental analysis involves looking at things that concern the broad economy and individual companies. So at the economy level, that means understanding where we are in the economic cycle. What's the current growth rate of the economy? What's the current inflation rate of the economy? What's the unemployment rate? And at the individual company level, that means looking at various metrics like revenues or price to earnings. It also means understanding the industry as a whole. It means looking at competitors and the supply chain. The other piece to trade identification is technical analysis. Now, there's so many technical indicators out there. I like to keep things simple. I use moving averages and RSI, but have a look around, get familiar with some technical indicators and start using them in your trade identification part of the process. The next part of an investment process is portfolio management. And this involves managing a trade once you've put it on. I would say if you're starting out in investing and trading, it's a good idea to have predefined or preset entry levels and exit levels. Exit levels are particularly important because it's important to have stop losses. It's also equally important to take profits when a trade has gone well. If you're more experienced, you can trade on the basis of incoming information and the novelty of that information. And this is a Bayesian approach. So what that means is if new significant material information comes in that affects your investment, you can update your take profit levels or your stop loss levels. And lastly, remember to diversify your portfolio. Invest in assets like gold and government bonds. This will help insulate your equity investments from market volatility, and it will make your portfolio more of an all-weather portfolio, a portfolio that performs in different market regimes. So we've covered a lot of ground here, and many of the concepts will require their own videos, which will be coming out soon. But to sum up, I want you to take away the following. Have a logical process. Don't just fly by the seat of your pants. Know what's happening in the economy before you invest. Understand what's happening at a company before you buy its shares. Be disciplined. Don't get emotionally attached to a position. If a trade's gone well and it's reached your take profit level, book some profits. No one ever got poor taking profits. And similarly, if a trade has reached your stop loss, take it off and move on. Live to fight another day. And lastly, take a bird's eye view. Always think about your portfolio holistically, and that means diversify. Think about assets like government bonds and gold. Think about your own personal risk appetite. Hedge fund strategies can be complicated, but at their core, they're just doing the simple things extremely well. Research, discipline, and diversification. There'll be some more videos coming out going into more detail in some of the concepts that we've covered today. So keep an eye out for those. If you like this video, please like and subscribe, and see you next time.